Before we begin this podcast, we would like to remind listeners that NetWealth is licensed to provide general financial product advice only, and that this podcast isn't tailored to any particular person's objectives, financial situation, or needs. Before a listener acts on any advice in this podcast, they need to think about whether it's appropriate for their circumstances or their clients, and consider the product disclosure statement for any proposed investment, and also seek any professional advice they need. NetWealth Investments Limited is the issuer of NetWealth financial products. For NetWealth Financial Services Guide, contact details, and other information about our products and services, you can visit our website at netwealth.com.au. Today's guest is a financial product issuer. NetWealth and the guest have a commercial arrangement that enables investment in products managed by the guest through NetWealth's platform. Under that arrangement, NetWealth may receive fees from the guest. More information about the fees NetWealth receives is provided in our financial services guide.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives. In this episode, we chat with Paul Chin, Head of Investment Strategy and Research at Jamieson Coote Bonds, on what impacts a late cycle market could have on the investing landscape and some potential ways to defend your wealth in this environment. We also examine bonds in detail and the benefits they can bring to a portfolio.
My name's Paul O'Connor and I'm Head of Investment Management and Research for NetWealth Investments Limited. Today we have Paul Chin. Paul works for Jamieson Coote Bonds, a Melbourne-based fixed interest specialist manager, and Paul's Head of Investment Strategy and Research. And I guess I thought it'd be a good opportunity to talk through what Jamieson Coote Bonds, or JCB's, view is on the market at the moment, and specifically what's going on with interest rates and the whole bond market in general. So good afternoon, Paul.
Hi, Paul. How are you? It's a pleasure to be with you today.
Good to catch up with you, Paul, and thanks for coming in. I thought we'd just start by opening with a bit of a general question, more around the global macro economy. And I guess what's JCB's sense as to the state of the world economy at the moment and where we might be in the economic cycle?
Paul, there's a lot to consider, and it really boils down to a few things. I'm not an alarmist by any stretch of the imagination, but once you lift the bonnet, I don't think things are as solid or as solid footing as one would expect. In fact, we're actually quite late cycle. And for instance, when you consider things like the sugar hits that we've had recently from President Trump in terms of goosing the tax cuts and the tax repatriation, leading to a number of responses from corporates, this is precisely at the wrong time in the cycle. And this is essentially going to magnify.
Sorry, Paul, what do you mean by late cycle and the impact and effect that will have on interest rates?
Yeah, so late cycle, we're essentially seeing earnings starting to top off. We're starting to see, broad, profitability start to tail off as well. And we're seeing increasingly the end of the business cycle where it's had a really strong run, as represented by a strong economy, and then also risk assets which have performed incredibly well over time. So, for instance, as a function of what's happened with regards to the global financial crisis, and the unconventional and conventional responses from central banks, we've seen risk assets really beefed up over time. So we've seen, for instance, Australian equities over 1.5% per annum higher than long-term trends. Australian property or listed property securities more than 16% higher than long-term trends, whereas developed markets on a risk basis has actually had lower volatility of 4% and emerging markets lower than 9% relative to trend. So I think investors have been really conditioned with regards to these kinds of conditions, which we just talked about, and I'm really concerned about that. But just stepping back, Paul, I'd really, one of the things we worry about at JCB are the enormous debt loads, which we've seen pick up from the dot-com bubble and
so
also
government debt, debt in the US
financial,
and even Australia, I guess.
Financial, non-financial, right across the spectrum. And when we have a look at a chart as well, that's really accelerated since Lehman Brothers or since global financial crisis. What does that mean? Well, so many corporates, so many governments have rolled over their debt at low to zero rates. And in a tightening sort of environment, we've seen the Fed raise rates. They're forecast to do one more for 2018 and several more in 2019, that's going to have an impact to the return profiles of these asset classes along the way. Just coming back also to late cycle as well, and how much of a sugar hit some of these initiatives have been. The good researchers at MIT, Illinois University and Harvard identified that for every $1 that came back in terms of repatriation of money, the shareholder payouts were in the neighbourhood of 60 to 90 cents in the dollar. Why do I say that? Well, these were designed to try and improve the real economy, but at the end of the day, a lot of these initiatives are, one, a sugar hit, and two, goosing the wrong part of the financial system. And that's a primary concern that we have, because combine the debt, combine these late cycle initiatives. President Trump, with all due respect, is a property type of guy who has tended to goose the portfolio or goose his investments at precisely the wrong time. And that's led to catastrophic circumstances in his own personal thing. From a global economy perspective, this is merely magnifying the sorts of downturns which we could have down the track.
So I guess, Paul, what you're saying is that late cycle will have an impact on the direction of interest rates. And what we have, I guess, been in an environment over the last decade of very low, benign interest rates. Potentially we could start to see an uptick in interest rates as an outcome of the end of the growth portion of the economic cycle. So if that's the case, what's your view on riskier assets such as shares and property?
Yeah, so as you were saying before, the returns have been incredibly strong for risky assets since the GFC, and that's a function of those conventional and unconventional policies from policymakers right around the world. My concern is investors have been conditioned to believe that that's going to continue. High returns, low risk. And my second concern is that these sorts of returns are just not replicable moving forward, particularly against long-term trends as well. So we just need to be, comfortable that our portfolios are balanced and that we right-size our expectations of our risky assets. In other words, we don't double down. We don't have unreasonable expectations and hope that equities or risky assets are going to drive the majority of long-term returns, because at the end of the day, it's not possible.
Yeah, I guess it's interesting, but as human beings, we can, weight more heavily more recent experiences in our lives as opposed to experiences maybe 10 years ago. And 10 years ago, obviously, we had the financial crisis. So just going back to that period, what were some of the learnings and experiences from these types of difficult periods that I guess JCB as an organisation is taking on in the management of the investment strategies of the bond funds you offer there, Paul?
Yeah, I'd highlight a few things. I think I was lucky or unlucky to be a portfolio manager during the GFC, and my hair's gone all grey as a result of that. But when I was involved in managing these multi-asset portfolios, it became clear to me that quality absolutely matters in these periods as well. That can act as a cushion. Quality assets have a premium during these periods. People value those sorts of high quality assets as ballast, as something which can be easily liquidated within their portfolios. I think the next crisis will be one of how good your assets are as a result. And I think, when we look at past difficult periods, dot-com bubble, GFC, one of the other lessons for me is definitely positioning your portfolio for the right reasons. When I look at a lot of the portfolios right across the Australian landscape, all the way, I speak a lot, I'm fortunate to touch base with institutions all the way through to financial advisors and individual investors. There's that sort of scope creep that's a silent risk which has really increased in people's portfolios. What do I mean by that? Well, because risky assets have had a tear since the GFC, that has oftentimes represented a larger portion of portfolios. So the risks which they're taking on is concerning. So my lesson, I guess, my final lesson from the last one has been making sure that you are doing things for the right reason and well balanced with your assets, and then you maintain your plan in place. If you're thinking about your equity and fixed income balances over time, making sure that you do rebalance and you remain disciplined and try and avoid some of those behavioural biases along the way.
Yeah, I think it's an interesting comment you make, Paul, around effectively what I view as the asset allocation of an individual's portfolio, where if you do have a 50-50 allocation to more defensive assets and more growth assets, and the growth assets have a great run like equities have had over the last 10 years, you end up with a significant overweight now to these growth assets. So I think it's a prudent comment you make there, Paul, that I think investors do need to consider and think about their asset allocation. In terms of the actual bond markets, what are you seeing in markets at the moment? And are you seeing any, trends that are typical of the late economic cycle?
Yeah, so fantastic question, Paul. I'm sure on this podcast there'll be a few country and western aficionados. And one of the gun sort of singers was a gentleman by the name of Waylon Jennings, who dodged a bullet by not being on the plane the day the music died, which Richie Valens and Buddy Holly died on. He went on to a successful career in country and western, but one of the songs which he wrote was this song called Looking for Love in All the Wrong Places. And when I think about financial markets and in particular bonds, I'm seeing a lot of participants look for returns in all the wrong places and looking for yield in all the wrong places. What do I mean by that? Well, you think about the richness of so many assets and how hard it is to get yield and get return in this environment. So many people in bonds are having to take on additional risk, take on credit exposure, take on asset-backed and mortgage-backed securities. In other words, levered type of assets which have a lot more risk embedded in them to squeeze out those returns. And what we're seeing, what I'm seeing in the bond market is that you're just not being sufficiently compensated for the risks which you're taking. We've seen these credit spreads really come in since the global financial crisis. So that's happy days for investors who have ridden that wave. But we've also seen from past history, and as a lesson from the last GFC, that these things can turn on a dime. Okay, these conditions, whether you're trying to liquidate a position, whether you're trying to reposition a portfolio, becomes really difficult on the turn of a dime. And it could be a Trump misstep or a policy misstep. It could be an earthquake or a tsunami to Japan or, a major city like Los Angeles and the like. It could be one of these sorts of things or a trade war outcome, which could trigger one of these sort of bad juju results. But the bottom line is that in the bond market, you want to make sure that, as we said, quality matters, and you try to be aware that the returns that you're seeking within the portfolio being well compensated for the risks you're taking in some of these instruments.
So I guess my takeout from that is you're starting to observe portfolios' defensive allocations becoming riskier and moving more into credit and away from the more safer traditional bond-like characteristics that definitely have a negative correlation with your growth assets and your equities.
Paul, right on the money. I mean, just to add to this, I think in 2018 alone, we've had some recent experience with regards to funds which have frozen or encountered some serious issues. That's not a comment on the managers themselves, but it is a comment about the rise of unconstrained bond funds, for instance. In this environment of low yields and harder to find returns, we're seeing, this rise of unconstrained bonds and absolute return bond funds. What that provides, though, is enormous latitude for the portfolio manager to basically invest anywhere they want across the fixed income spectrum. They can introduce a lot more risk and not provide that transparency of what they're investing in. And so what we have seen again in 2018, a number of funds have encountered problems who have invested like this, and the investors who have invested in this have really suffered. They haven't been able to redeem their funds without a significant gate in place. And they've received their funds, if they have, at enormous discount to what they were marked at initially. So I think that is one of the one of the lessons for me also with regards to the current bond market.
Yeah, no, it's interesting there. And I think a salient takeaway I certainly get out of Paul's comments there is that particularly you want to be cautious about having too aggressive credit exposure in your defensive portfolio because, as we made the comment earlier, that the defensive should really be there to defend and act as a shock absorber in your portfolio when your growth assets are actually selling off. And unfortunately, the more aggressive credit tends to trade like an equity and does not give you that defensive characteristic when you need it most.
Yeah, and just to add to that, Paul, because so we focus a lot on that credit and levered type of instrument. So we spent a bit of time earlier today on high-grade bonds and the fact that it derives its exposure from a different risk stack, right? So government, semi-government and supranationals mean that you're not tied or you're not tethered to that financial sector risk and ultimately the housing market here in Australia. You have a different source of risk which can hopefully perform in a different way, but more particularly to tie your point back, Paul, provide that left tail protection and provide, principal and income liquidity and diversification against your growth and risky assets. So, it is being deliberate about what you use in your defensive portfolio.
No, interesting there. And I guess it is very much a challenge for the investors to navigate their way through this part of the economic cycle and to understand how their portfolios should be positioned. And I guess particularly if you're approaching or you've just entered into the early days of retirement. Do you have any thoughts, Paul, about positioning your portfolios, given where we are, I think undeniably in the late stage of the economic cycle?
Yeah, so Australian investors are chronically underweight bonds. So they currently sit, according to the 2017 Willis Towers Watson report, at 14%. And that contrasts, to the US at 21, UK at 35, Japan 56. That's a slight anomaly. Netherlands at 50%. These are substantially higher than Australia, and that's a function of us being, equity-based, risk-based culture. We love amputation credits. We love, these big four banks and the like, but they're missing out on the benefits of bonds and in particular high-grade bonds in portfolios. So again, if you're thinking about retirement or you are in retirement, you do have to right-size your expectations, right? So, and not avoid asset classes because, such as bonds, because of the relative yields and the like. The bottom line is that bonds and high-grade bonds have a real role to play in terms of providing a reasonable yield. And so I would be making sure that I have a reasonable allocation to that in partnership with other parts of the complex. Credit has a role, hybrids, if that's what your bags is, and you're sufficiently, knowledgeable and have the time to go through that kind of stuff. But at the end of the day, these sorts of exposures, high-grade bonds, can provide that left tail protection and provide ballast when you need them in your portfolios. So bottom line is, don't abandon bonds given where things are at. And we had a reminder during 2018 in October with a little scare. We saw, a sea of red with regards to Australian shares. For instance, in the month of October, we had a minus 6% outcome, minus 5% for global shares, whereas Australian bonds and high-grade bonds came in at 50 basis points. So it zigged when the others zagged and provided that ballast for portfolios. So I think that's a valuable reminder. Right sizing, you do have in retirement a substantial amount of period left to keep your portfolio going. So you do need growth assets, but equally as well, you need to have a level of ballast to protect and defend on the downside.
No, that sounds rational there, Paul. Thanks for those thoughts. I know, there is, I guess, a lack of understanding from a lot of investors in the market about actually what bonds are and are they all the same. I know potentially I've been guilty so far in this discussion where I've introduced the term credit, etc. there, but in fact there is a very broad differing risk and return characteristic of more traditional government bonds through to riskier companies issuing credit. and raising money there. So can you highlight potentially for our listeners some of the categories of bonds and I guess, a few comments around how they behave?
Yeah, so at the end of the day, this is all about a risk-reward spectrum and the like. And I would say at the lowest return and risk expectations would be your sovereigns or your high-grade bonds, your sovereigns, your state-based paper and supranationals. These are backed explicitly by a range of AA or AAA rated issuers as done by S&P, Fitch and Moody's, so really credible type of ratings agencies and the like. Now, as you move up the spectrum though, you've got things like mortgage-backed or asset-backed securities, corporate debts and bank loans. In other words, you don't have the full faith explicitly of the government to make good on your obligations. These are beholden to how the given corporate is performing. In benign times, it's happy days, break open the champagne. It's, very solid, providing us an ongoing sort of coupon stream for investors. But a lot of this becomes discretionary for the issuer as well in times of stress. And I think that's, my biggest concern, particularly when you move up that risk ladder, when you think about high yield, which is just another form, except the credit rating is lower on the rung, and then mezzanine debt, which is one level below equity and the like. At the end of the day, these things become less discretion or more discretionary for the issuer. Things like covenant-light loans, which have been incredibly popular in the US, have been a popular way for corporates to raise cash, but it's all the terms are favoured in terms of towards the issuer. How much documentation, how much transparency, the triggers for stopping a lot of these income payments being made. So if you're looking for a truly defensive outcome, this isn't it, but going up that food chain. Why is that? Well, as we said, a lot of these higher risky assets that that you and I have talked about, Paul, become far more equity-like during times of stress. And so when you overlay how late cycle we are, how we can't keep going in terms of this business cycle and proceeding along our merry way, we are going to hit a pothole and we are going to get stressed. And when you overlay how much debt we've got, that is going to be magnified quite significantly. So these sorts of risky assets with higher return expectations and have done incredibly well since the global financial crisis, are less likely to deliver those sorts of outcomes, in this late cycle and post-late cycle environment.
Yes, no, I do recall vividly the significant losses on credit and more aggressive credit in 2009 and 2010, where we saw some of those securities down 30-40%. And the original investor went in the hope of receiving a 5% yield. And they ended up with capital losses of over 30%. So I think, again, that gives or brings to life a good example of where certain areas of the fixed interest market can be a lot more like the equity market in the way it behaves. So ultimately then, what are the defensive qualities of a high-grade bond? What makes them more defensive and secure? And then naturally they don't have the allure of some of these higher yielding, more aggressive credit-like securities there. But what actually makes a government bond less risky than a credit issued by a company? Yeah,
so the sovereign bonds, the Australian Commonwealth Government explicitly back those securities. So you can have the full confidence that you've got the full faith and backing of these governments, AAA rated, one of 10 remaining AAA rated countries. So that's a good news story, and you can take away that confidence. The same cannot be said for credit. The several reasons why you invest in high-grade bonds, so the principal and income stability in a very liquid package, the left tail protection, so you basically file this away, ready to go, hopefully in your portfolio. Hopefully you don't need it, but when you do need it, think of stressful periods in recent times. Think of the dot-com bubble. Think of the global financial crisis, which we've talked a bit about in this session, the US downgrade in 2011, and think about also Greek and Chinese concerns in 2015, 2016. In all of these circumstances, Australian shares got absolutely smoked. Okay, down like 30+% during the GFC, down 15% during the dot-com bubble. We see a red in nearly 14% in the Greek Chinese concerns in 2015-16. Whereas out of all the other asset classes, credit included, high-grade bonds were there to defend and protect, and they were the best performing asset class in these circumstances. So then the natural question would be, okay, can that relationship continue given where yields are? And what I would say to you, though, Paul, is that this is a self-rebalancing asset class, okay? What I mean by that is, okay, over the shorter term, nearer term examples, you might get a bit of fluctuation with regards to high-grade bonds, as prices change. But if you're getting a rising rate environment because inflation is increasing or growth is overheating for the global economy, what you will see is that the maturing bonds need to be reinvested at the prevailing yield. Rising yields mean that you're reinvesting at cheaper bond prices, which means you're getting more. You've got the coupons, which are having to be reinvested similarly as well. Why is that cool? Well, that's cool because Albert Einstein's eighth wonder of the world, that is compounding. And this is a self-rebalancing compounding asset class where if you're getting the coupons and the maturing bonds reinvested, and you have the right sort of time frame, not short, but over an extended time period, you will be in a much better position as well. And so even where yield's concerned, and Bank of America Merrill Lynch did some wonderful research on this, it illustrated the point that an Australian investor who invested at the depths of yield, 10-year yields in 2015 all the way through to 2035 would have received a 650% plus simple return over that period simply because of that compounding. You can't do that with regards to credit. Credit, you will have, if yields increased to the same magnitude, you would have defaults, bankruptcies, bad news stories, right? And so that clearly differentiates. You do it for liquidity, you do it for principal income stability, you do it for diversification against your growth and risky assets, and that left tail protection in portfolios.
Thank you. Well, I guess do you have any final thoughts for listeners here there, Paul, that you can leave us with? Yeah,
I'd leave two thoughts. I think, firstly, it's absolutely important that you don't be complacent about investment markets right now. It's easy to become complacent given recent memory, as you said, Paul, and the impact to expectations. I would equally as well be clear about what you're looking for in your investments. If you're trying to generate a strong sort of wealth outcome which hits your objectives, manager selection is an important thing. Being able to pick somebody who's got a strong talent pool, who are seasoned, who've been there, done that, who have a repeatable process, a defined policy as well, and then think about the performance outcomes as well. So the performance, obviously you prefer higher relative to lower, but also in defense, thinking about lower volatility, something which provides lower beta, something which can have a shallower and faster turnaround to drawdowns as well. If you can pick up a manager who can do that, you will actually do much better over the long haul for your wealth. And that's something, it's important to think about when you're constructing portfolios in this late cycle environment.
Absolutely. Well, thank you very much there, Paul, for providing us your thoughts and insights into, I guess, your view and Jamieson Coote Bonds' view on the market there. And I think it's also fair to say, back to your comment earlier about Waylon Jennings there, that I do like both types of music as well, country and western. So thank you very much, listeners, for joining us for the discussion with Paul today. All the best with your investment portfolios, and I look forward to joining you again shortly for another podcast.
Thanks for listening to this episode of the Net Wealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.